Hello and welcome to another episode of Southbank Live. My name is Boaz Shoshan and I'm joined as ever by John Butler for episode 22 of the show. Thank you so much for joining me, John. How are you getting on this week?
Yeah, very well as always. How about you, Buzz?
Oh, very well indeed. I apologize to our audience that I wasn't here for last week's show, though. The noble Kit Winder did stand in for me with Charlie Morris. I was away on a rather long and intensive pub crawl in Belfast. It was very good indeed. I would recommend the pubs in Belfast to anybody. It's very good. But now I am back in Staffordshire and ready to continue with the show. Now, there are some incredibly big themes we have to discuss in this show, John. Before we do get started with that, thanks to everybody who has tuned in with us this evening. It is great to be back. Do feel free to leave any questions you'd like me to ask or you'd like us to discuss, any themes you want us to cover in the show. It's a free-for-all, though it has to be investment-related, please. We can't do anything aside from that. And, of course, we cannot give you personal financial advice. We can only just discuss these big themes. So this week we will be looking at the Omicron variant and what it means for markets, along with what the Fed chair was talking about when he said that inflation is no longer transitory, what that means for markets. Now, John, are you getting any deja vu with the Omicron variant? And if so, deja vu back to when?
Well, you're mixing up French vocabulary with the Greek alphabet. But look,
As one does.
I have to say I do agree with you. It feels a lot like the initial concern around Delta. We know now, because Delta's been with us for a long time, we know that it is considerably more contagious, perhaps, than some of the initial variants that were around, and yet less deadly, resulting in far lower hospitalizations. And indeed, that data was available even before the vaccine rollout kind of reached a meaningful level. And so even amongst unvaxxed, Delta was never as deadly as the initial stuff. And this appears to be even less deadly than Delta. And of course, everyone who wants to be vaxxed, presumably, is now vaxxed, and for that matter, they're also boosted. So I don't think Omicron in of itself is going to be disruptive. However, governments are reacting to it in ways which are disruptive. And so I think the real concern here is that some governments, and in fact, it's a growing number, it would seem, they've kind of slipped into this bad habit. When in doubt, assume the worst, which might sound benign if you're the person in power, but if you're the person trying to run a business, especially in hospitality, travel, these businesses that are based entirely around human-to-human contact, including sometimes with large crowds, it's disastrous. I mean, how many times are we going to go through this? So I think based on just reading the tea leaves, as it were, this will be disruptive, but I'm not sure it needs to be. And it's kind of sad, really, if you ask me.
It does feel like governments have kind of got into a rhythm with this, and it's maybe not the best rhythm, but future, we don't know how bad it is. And some people would say, well, they're getting their deja vu is even before Delta. This is before even we even knew what coronavirus was, and we all just thought corona was a form of lager. And back in 2019, when everyone was all hyped up for whatever 2020 was going to be, and it was a horrible surprise in the end. So some folks think, maybe this is we're leading up to a March 2020 event. Do you think there's any evidence to support that? And of course, we are just looking at this from an investment level, where you've got lots of interesting dynamics in play, rather than, of course, from a pharmacological perspective. We're not in the pharmaceuticals business.
Well, look, I mean, even though some, choose your index, some equity markets had crept to new all-time highs before this recent scare arrived, but momentum is not what it was. And price, sort of profit expectations, earnings momentum are not what they were. The equity market has been carrying a heavier load in recent months anyway, prior to this most recent scare. So the idea that we could go through a major market event comparable to spring of 2020 based on Omicron alone, I think is unlikely. Based on an overreaction by governments, more likely. And actually, if I had to pinpoint what I thought was the most likely reason that markets are going to reassess here, it actually has more to do with what Fed Chairman Powell said earlier this week. That, to me, is actually more meaningful than Omicron, or at least for what we've seen so far, government reactions to Omicron. I think that is the reason why the market should be afraid here.
That's very interesting, John. Quite a bold statement too. I would like to come on to that, though, just in a little bit later on. Liam says, "Really felt looking forward to this show. Last week's was so entertaining. John Butler is incredibly knowledgeable." Well, thank you so much for tuning in, Liam. It's great to have you
Yes,
here.
thank you very much.
And Robin says, "I'll have a pint of Omnicom," which with a smiley face. Well, thank you, Robin. Thank you for your contribution there. I'll make that 2 pints. I'll have one too. Now, John, looking at the government's response, similar to you, this is just my own gut feeling. Like we were saying, how governments got into this sort of rhythm with how they deal with this. I think the government response is going to be what really pushes the markets. And maybe it was the government response as well, which really pushed the markets around last time because it was shutting down the economy. One can speculate whether or not, if everything had stayed open, whether or not there would have been the same level of crash. Maybe we could look at what the Swedish stock market did, for example. But in terms of the amount of restrictions we're seeing, so Austria and Germany being perhaps big offenders here, do you think, and this is market related, there's so much politics involved, it makes it quite hard to discern. Do you think we're going to get another round of lockdowns?
Well, obviously, you're getting pockets of it in places, but they're increasingly unpopular in other places. And the thing is that it seems that politicians claiming that this is what their advisors are telling them, that they say they're following the science. And yet the fact is that if something becomes more infectious, but less deadly, well, then it's doing what viruses normally do, right? And if it ends up being like the common cold, well, it just begins to look a little bit ridiculous that you're locking down economies because variants keep coming around that might be more transmissible, but are less deadly. And as a result, put far less pressure on the health service and so on and so forth. So we're seeing a push from both sides. We're seeing a bottom up grassroots push in many countries that locked down really hard to ease off, whereas other countries are saying, "Oh no, we've got to lock down again because of a new variant." I suspect when these two forces meet, because they're going to meet more and more frequently now, I believe, I think it's going to be harder for governments to continue to push through heavy-handed, "Oh, gee, let's be safe. Oh, we can't take any risks. Oh, let's shut everything down." It's going to get harder and harder and harder to justify those sorts of policies in the face of meaningful public resistance. And it's way more meaningful today than it was in the spring of 2020 when everybody was embracing the vaccine rollout. Everyone was hopeful that normality would return. Now, I mean, it's everyone just assumes normality should return. And the grassroots momentum is much greater than it was as a result. So I think governments may try, but I think Austria and Germany and other countries that go down that road will be in the minority this time around.
Well, I would certainly hope so, John. And this actually ties in a little bit to our long-short segment, which we'll come to a fair bit later on. We do have a question actually from David saying, "Why aren't recent Russian and Chinese acts of aggression more important?" And in regarding the stock market, what would you say to that? I mean, I do know, of course, that we are referring to the Omicron variant and not the Xi variant, because they have decided to skip a little further in the Greek alphabet, and maybe that has something to do with why it's not important. But I'll let you answer that.
Well, look, I mean, obviously, if what is happening along the borders of Belarus and Ukraine, or what is happening with Taiwan, if these things escalate, I mean, all bets are off. Obviously, okay, absolutely. But things like that, I mean, who on earth can possibly predict at what point things go critical. If we simply stay as we are now, with there being some sort of showdown, but in both theaters, but one which hopefully will be resolved through some behind the scenes, behind closed doors discussions. Hopefully, the market will be able to shrug that off. But God forbid, for whatever reason, things get hot, either around Belarus, Ukraine in the west, or around Taiwan in the east. Oh my God! I mean, the clearly markets are vulnerable to that, hugely vulnerable to that. And if you think all of the inflation, all of the logistical nightmares that are still being resolved for trade around the world, if you think that what we've seen up to this point is
It was
problematic,
bad.
just wait until you have an actual military conflict interfering with global shipping and just global trade in general. Talk about things going from bad to worse. I mean, we will see inflation and probably stagflation, if you want to add in the negative growth aspect, an order of magnitude higher than what we've seen so far.
Yeah, to answer David's question, they are very important. The recent Russian and Chinese acts of aggression, and investors can't really afford to not look at it, because in a way where we're no longer in the first Cold War anymore, and post globalization, post fall of the Berlin Wall, markets have become very immune to actual kinetic conflict disturbing global trade. And so if we did see something like that, markets would be very, very unprepared for it, because they've not seen anything like that for an awfully long time. So people trading the markets are not the same as they were back in the Cold War. So if that did occur, then there would be very grave consequences. It'd get people very much unawares. But that should probably be the focus of another episode. And heaven forbid that either of those things does happen, because it'll be very bad news for an awful lot of people. Moving slightly on, and this, I believe, kind of echoes one of my previous questions, John. Alan, who tunes in, has said, if there is any indication that the current vaccines are greatly less effective against Omicron, what scale of drop do you see in the market, both sides of the pond, respectively? Thanks, guys. Thank you for that question, Alan. That's what I'd be thinking of when we're thinking of a repeat of March 2020. Though perhaps the what would happen next would be maybe a little bit different. So March 2020 was when COVID-19 sort of really got into the market in a big way, when we saw that incredible flash crash occur. John, you've already said you do believe that Omicron, and hopefully Omicron is less lethal but simply more transmissible, and that
So it appears based on available data, right?
But if we were to hypothesize that the data that is available thus far is incorrect, and it's actually really, really bad, what would you expect in terms of both sides of the pond? Sorry.
Well, look, the idea that we can still be in an environment of elevated equity valuations in a world that descends into a properly deadly pandemic as opposed to just a scare. I mean, there's no way, right? We would have to see tremendous repricing of markets. And I mean, just to put things in perspective, I believe the S&P multiple is currently around 22 times trailing earnings. And I think if you look at big tech, which of course is a big part of that nowadays, it's over 30 still. I mean, these are huge multiples. And yes, they are justified in mathematical valuation terms to some extent by what is still a historically low level of bond yields. But that low level of bond yields is increasingly incompatible with an inflationary environment. And lockdowns are supply shocks. They are inflationary. They constrain supply, but the underlying demand for all kinds of basic food, clothing, and shelter is still there. And we assume governments are going to throw money at the problem to make sure that food, clothing, and shelter are still provided to those in need, regardless of the state of lockdown that we're in. And so it is a very, very inflationary negative supply shock situation, which is completely incompatible with these sorts of multiples on equity markets. I'm sorry. And so if you want to go back, to the 1970s, and if you want to take a look at sort of where multiples tended to be, we're talking about the teens. Okay. well down in the teens, perhaps,
Yeah.
for the broader market. And so, if you're going to go from 22 times trailing earnings to 15, let's kind of take the middle of that area. I mean, that's a third off the market from here. And if you assume, as I do, that tech is actually more vulnerable to this sort of thing because provision of basic food, clothing, and shelter does not imply big subsidies for big tech, right? You're going to see an even bigger drop. And so if big tech also settles down into somewhere inside of 20, say, still retaining some growth premium over the broader market, I mean, that's cutting tech valuations by over a third. So, I mean, anyway, that's kind of how I see the risk playing out there if we go into properly hard, properly deadly pandemic lockdown measures.
Yes, does sound very gnarly indeed, John. And as I say, I do hope that's not what we're going to encounter, and indeed, it's not what you expect we shall encounter. So, hope that answers your question to Alan. Now, on the same note, we are getting loads and loads of questions, which is great to see, folks. Thank you all
Yeah.
for tuning in. If you do like if you are enjoying the show, do feel free to give us a like and to subscribe to our channel. We shall try and to answer them as best we can within the confines of the show. And we've got a fair bit of time left, so we shall. But before we answer some more questions, I'd like to move to our second topic, and that is what you said is even more important for markets, at least, than Omicron, John. So looking at Jerome Powell, the chair of the Federal Reserve, and what he meant when he was questioned. I believe it was Pat Toomey, who the senator, who asked him, why everything is transitory, life is transitory. What how long must inflation carry on before we stop calling it transitory? To which he replied, well, I guess we'll just stop calling it transitory then. We need to find a new word for it. Now, this is very interesting to see somebody sort of self-correct like that, considering how often we've seen the word transitory. And then for the person that really brought it about to say, actually, we're not doing that anymore. That's not fashionable. I'm wearing new shoes this week. What do you think that means for markets, John? Because inflation and the Fed, and what the Fed does about inflation, is really the name of the game, aside from the new COVID variant.
Oh, look, the Fed is still the dominant central bank in the world, of course. And if the Fed is going to make any meaningful policy shift, that's going to have an effect everywhere. And indeed, it's kind of implicitly already having an effect everywhere because the dollar has been relatively strong. And why is the dollar relatively strong? Well, because people have been assuming that at some point the Fed's going to get it in gear and start tapering and raising interest rates. And now you have the recently confirmed second term chairman of the Fed, and those terms, right? those terms are 7 years long. You have the recently reconfirmed chairman of the Fed, who is going to basically say this isn't transitory anymore. He feels he has a mandate to sort out what appears to be a non-transitory inflation problem. We haven't seen that really since Paul Volcker was around. That is, to have someone come in in Volcker's case, it was his first term, but here you've got Powell being reconfirmed to a second term. We haven't seen someone come in amidst such a big surge in inflation and state straight away, right off the bat, we have an inflation problem. This is not transitory. The message is clear. Powell is preparing the market for a substantial increase in interest rates. Now, it may never happen. The market may crash. There might be disorder. It might not happen. But if things continue as they are, if the equity market continues to be at these elevated valuations and inflation remains elevated too, Powell is going to raise rates, perhaps by more than markets expect. It is, again, a very dangerous environment for markets when a Fed chairman feels he has a mandate based on a new term and based on an inflation problem that is clearly not something one can ignore. And now he's actually said it, right? He's acknowledged it. I think it's a big deal.
It is a very big deal, John. And are we rooting for Powell here? Is he the good guy now? Right? Is he actually taking the right course of action? Would you say?
Look, we're so deep into this mess, right? There's no easy way
There's
out.
no
There's that
good
old
guys or
Irish
bad guys.
proverb, right? The young Irish man is walking across the countryside, and a young Irishman is walking across the countryside, comes across an old Irishman, and he figures the old guy, sort of knows where things are at, and he says, "Hey, excuse me, sir, do you know the way to Dublin?" And the old man replies, "Well, I wouldn't start from here, son." And I think that's really kind of, nobody wants to be in this position. No central bank wants to be facing this sort of situation. There are no good choices. However, Powell's old enough to remember, of course, what Volcker did. In the end, Volcker was lauded as a hero, and I think rightly so. I think that's fairly deserved. But the fact is, the United States is a far more indebted, less productive place than it was back when Volcker was around. Yes, the 70s were a difficult decade, but they were a difficult decade which was characterized by a much larger workforce. It was characterized by a federal government with running far lower deficits, with a far lower accumulated debt. The United States, while it had become a net importer by the 1970s, there wasn't much in it. Whereas today, the US is hugely reliant on imports from the rest of the world. And of course, that includes energy. And so it's a different animal. It's kind of like when Volcker was around, he was trying to steer the ship, and the ship was, say, a Panamax size ship that was still able to maneuver through the Panama Canal. Powell's in charge today, and he's at the helm of a Supermax ship, which is that much bigger, that much less maneuverable, that much more difficult to turn around. And I'm not sure anyone is up to that job.
No, it doesn't feel like a place you'd really want to be in unless you're something of an adrenaline junkie and can take a lot of flack. Because going to your point, John, Volcker, way back when he started really aggressively hiking interest rates and killing inflation, there were people after his head. There were people protesting, in Washington D.C., saying, this guy needs to be removed. He's crippling us. I believe it was a big part of the agricultural community, because they had been used to the inflationary pressures, and they'd based their businesses around it. So when they saw the high interest rates reining all of that in, it was causing a lot of them to go bankrupt, and it was very bad for them. It was really not a good time to be Paul Volcker unless you could really take all that heat. So it'll be interesting to see if Powell gets vilified in the press now that he's starting to do the thing that is considered bad for the markets. Because if we do see this happen, and he starts taking the money, the printing presses away from the equity market and the assurances that come with that, it does feel like the worm's going to turn on his reputation.
Look, I mean, the guy's just been reappointed, okay? He kind of has an implied mandate now. It's not clear whether he will choose to exercise it or not. But now's his moment. I mean, if he's going to get religion and try to fix this inflation problem, he's going to have to get to it. Now, that said, remember, the source of a lot of this inflation is the original negative supply shocks from 2020, which, whatever people thought were necessary. And yet it looks like, and he's telling us this, the inflation thereby generated is becoming embedded in the system. People are simply beginning to expect higher prices. They're demanding higher wages as a result. They're not going to wait now and see what happens. They just kind of assume prices are going to keep going up. That change of psychology, it is a sort of a social tipping point, and it's very difficult to deal with. The only way Volcker really dealt with it was by forcing entire industries to have to literally downscale and let a lot of workers go to come to terms with the new reality that you just weren't going to get paid as much as you were. And certainly in construction, this was true. I mean, you mentioned about how unpopular Volcker was in the early 80s. Absolutely. The construction industry, or at least some elements thereof, they sent huge piles of lumber to his office, literally dumping it at the front of the Federal Reserve, and all the 2x4 plywood, timbers, they were signed by construction workers who had lost their jobs, and they had all this excess lumber they had nothing to do with. So they signed it and sent it to Volcker's office at 130 Liberty Street, I think it is, in New York. And I mean, could that happen again? Of course it could. But if Powell is going to get religion, it'll be now. He's not going to wait. He either acts now or he's probably not going to act at all. I think we're going to learn an awful lot over the next few months.
Yeah, it certainly feels like we've reached a major tipping point with him saying that inflation is no longer transitory. John,
Yeah.
if we were to see something of a repeat of that, do you think it would be things like lumber that would be the most affected by a really steep rise in interest rates, or do you think it'd be other sectors who would be protesting and sending various objects to Powell's office?
Oh, look, it's anything that is growth sensitive is going to be crushed if the Fed gets very, very serious about trying to bring inflation down quickly. Now, that said, I think even based on his recent language, I think Powell is going to tiptoe into this. But again, you're tiptoeing into a minefield, right? A debt and leverage minefield. And a minefield is actually a really good analogy because you know the mines are out there, you just don't know precisely where they are. And if you do happen to step on one, oops, you can cause a financial crisis. Powell knows this. So he will be tiptoeing into the minefield. But I think it sounds like he's going to give it a go. And he's going to, do what he can with his accumulated experience. But there are many growth-oriented industries, such as construction, obviously being an obvious one, and the broader housing market and everything that goes with that. Durable goods, right? Who in their right mind is going to go out and take on a bunch of debt to buy a whole bunch of new white goods or other durable goods or a new car when they're facing higher and higher and higher interest rates ahead as a result of the Fed getting some religion? No, people are going to make do with what they have. So don't get me wrong, they're still going to need basic food, clothing, and shelter, but they'll need non-discretionary food, clothing, and shelter. So all the discretionary growth-related stuff in the market is going to be whacked. And again, this is where tech gets in trouble. How does tech make its money? It makes a lot of money from advertising. Advertising is not out there to get people to buy non-discretionary goods primarily. It's out there to get people to buy discretionary goods primarily. And all of that is going to come crashing down if the Fed gets serious about raising interest rates.
Right. If we put Omicron aside, then, and we just imagine we're just looking at the market and the Fed raising interest rates. So we assume inflation is out of the bag. It's here. It's no longer transitory. There's a change in psychology. People are demanding higher wages and they're paying higher prices, and they're anticipating higher prices as well. Where do you think things start to get really shaky for equity markets and for the Fed's response? Because there's one follows the other here. And of course, I'm putting you on the spot with a really, a $1 trillion question ultimately, John. But if you had to guess with where things start to get really shaky, where would that be? I mean, is that in the near future? Is this, second quarter of next year?
Well,
Of
look,
course, this is leaving Omicron aside, which of
we're in
course is a
December
big thing.
now. We're in December now, and oddly enough, the timing is such that the months in which major market corrections tend to happen it's amazing how many of them fall in September, October, and November. Usually, if you've made it to December, you get a Santa Claus rally, if anything, right? And then you have to, and then in January and February, what you have is you have all the seasonal adjustment around the data, which makes it more difficult for markets to know what's going on. It's very, very hard to look at December to January to February data and make sense of some of the large seasonal adjustments for consumer behavior and things like that. And so you usually wait until March, the next month, when markets sometimes suffer a blow. And I mean suffer a blow in this case from some non-specific, just who knows what it was, tends to be in the spring. And again, we actually saw that, but in 2020, but you could say that was because of the arrival of Delta and the second round of lockdown and whatnot. So I mean, it's hard to it's hard to explain that one with reference to kind of non-specific market dynamics. But
Yeah.
anyway, the timing isn't right now is kind of what I'm getting at. There would need to be some properly bad news. Again, big reaction to Omicron would be potentially something meaningful. The Fed surprising the market with a sudden overnight 50 basis point emergency rate hike. Oh my God, that would do it.
Yeah.
As mentioned earlier, something kicking off with Taiwan in the East or Belarus and Ukraine in Europe. that could do it. But if we're just going to let the market correct under its own weight over the gradual realization that inflation is too high, the Fed's going to do something about it, I don't think it happens this month. It might happen in January, but I think maybe you make it all the way through to March before the market really wakes up to it and says, no, we need to reprice now.
I asked you a very, very tricky question there, John. Thank you
Obviously.
for that answer. Very, very noble attempt at it, I must say. Similarly, I think we should probably dedicate a future episode to this before we get to Christmas on the possibility of a Santa rally, because it's a very interesting dynamic. Just for whatever reason, stocks like going up near Christmas,
Yeah.
and yeah, but on that, you think it will take a while before this dynamic really starts to get negative, and markets really start waking up to this whole inflation rate hikes thing. Would like to go through a few questions on this because we have been receiving quite a few on this topic. Let's see. Right. So Robin asked, maybe we should be buying Raytheon, I believe the largest seller of guided missiles, at least the largest seller of guided missiles that's publicly listed. I guess this is referring to maybe the future conflict. Of course, we can't give you specific stock tips, but Raytheon is very, very highly held within the aerospace and defense sector. Very, very popular for those who like things that go boom. Do you have any, in terms of in an inflationary dynamic, John, air defense generally does pretty well there, right?
Yeah, the defense industry has good pricing power because the fact is that there's not a whole lot of competition in it. Industries with a lot of competition don't have much pricing power, but industries with very little competition have generally very, very good pricing power. And obviously, if you're entering a world which is increasingly unstable due to a variety of, the U.S. withdrawing from Afghanistan, Russia reasserting its power in Central and Eastern Europe, using gas as a weapon, hopefully not in a way that leads to a general energy crisis, but clearly Russia's using it for leverage. We all know that, it's obvious. The simmering dispute still in Ukraine. Look, there's a long and growing list of disputes in the world today, and it is what it is. I try to see through the good guys, bad guys side of thing and approach it as objectively as I can, as an investor should, in my opinion. And yes, the world's a dangerous place, and I'm afraid it is more dangerous today than it was a few years ago. And so, if that's true, then defense stocks look like a relative safe haven in the event we get into a general correction. I mean, if the market doesn't correct, fine. Tech will keep leading the way up, I suppose, based on all the lofty expectations there. But if the market is going to correct, I think defense in this context is a safe haven sector.
Yes, I would certainly agree with that, especially when we're talking about all the rising military tensions that go on the back of it, and not just inflation. Steve comments, I am deeply concerned that the government wishes to promote inflation by any means to deflate the value of the accumulated debt. Well, Steve, you're in very good company here. Both myself and John feel the same way, and I imagine many viewers do. That's one of the reasons why we're big fans of precious metals. I can imagine a lot of the people who've just been worrying in the government about all of the public debt that there is out there, especially over the coronavirus period, are probably, well, I say probably, some of them, I imagine, are secretly, without mentioning it publicly, of course, quite chirpy over the higher inflation levels, because it's going to get rid of all this debt, all the big problem that everybody has been worrying about since the financial crisis. It's finally here. A lot of the central banks have been trying to explain how they've not been able to create inflation. Now, party time. The champagne has finally arrived, and they can start doling it out and measuring it and all the things that they'd like to do. So, Steve, thanks for joining us. I'm deeply concerned too. Barry asked, do you have a view on Alibaba and the Chinese market generally? This is quite a big question, so we won't dwell too long on it. Personally, Barry, I wouldn't trust leaving a lot of money in China in general, especially when things are getting quite hawkish over there. It's never been a totally open, free capital economy, so getting your money out has often been very tricky. And if things do go awry, then you may not get your money out. That said, they've been able to boast very high yields recently, especially if you're a bond investor. And of course, there've been some strong growth. So it depends what your attitude to risk is when it comes to that market, and of course, what your opinion is on the Chinese government, because it is simply not a free market economy. There is no such thing really as private property in China if the state wants that, wants said property. John, what would be your take on the Chinese market at the minute? Because it's a very interesting inflection point with what's going on in the States.
Well, look, China's had a great run, right? But actually, I mean, depending on how you choose to look at the data, you can actually make a case, I believe, that China's in recession. And I know that might sound a bit controversial, but the fact is that China's growth has been driven in recent years by infrastructure investment and exports. Okay, these are the big drivers. And infrastructure investment is way down. A steel production, which is perhaps the single best benchmark, sort of universal measure of infrastructure in China, steel production is way down from where it was. And that helps to explain why iron ore prices have collapsed. And also steel prices themselves are much lower than they were. Also, coal prices have come way down. So there's less demand for energy generally, or certainly imports of coal to China. There's far less demand. And these are the sorts of signs you can't dismiss. And so I think the Chinese infrastructure economy is much weaker than it was. That's partly by design. China came out of lockdown first. The economy began to overheat. They actually did tighten credit. They wanted it to slow down. But it could be that they kind of overdid it, as it were. And obviously you have the overhang of a lot of the speculation in property and whatnot that's been going on, which has been coming off. There was the whole Evergrande saga earlier this year and so on and so forth. Then there's the export side. Yes, we got a post-COVID boom, absolutely. And that's hence why we've seen all these logistical headaches all over the world pretty much. But that post-COVID boom appears to have come off now. The rest of the world's economies are beginning to slow. There is the logistical hangover, which is keeping inflation elevated. And of course, there's the fact that governments threw a lot of money around, which has contributed to that too. But if you look at leading indicators, they are rolling over in most of the world. So China, I think, may have slipped into recession here. And given how much speculation has driven the Chinese market in recent years, you know what? It's a dangerous place to be now, in my opinion. And Boaz, you also mentioned the other reasons regarding the whole structure of the market and the economy there. So I would be very cautious on China here.
One thing that we've dwelt on in previous episodes is the rise of ESG investing, where people are trying to be very virtuous with how they allocate their capital. Interestingly, China's been given a lot of a free pass when it comes to that thus far. Personally, I do think that's going to change. If you look into what is going on in Xinjiang with the Uyghurs, the US has straight up labeled what's going on there as genocide. I do feel that there's going to be a big investor backlash against that eventually, and that's one of the reasons why not only do I not own any Chinese stocks, but I also do my best to boycott Chinese goods. Not because I have anything against the average man in China, but because if you're buying goods that are produced there, you're helping capitalize a Chinese bank. And because Chinese banks are effectively state utilities to a large degree, they can use that capital to leverage out, to create credit and drive it to various purposes, which are not very nice. I try to avoid that. Now, moving on a little bit here, and going back to the inflation narrative once again a little bit. John asks, good evening. Do you think NATO will intervene when Russia invades the Ukraine? Another very difficult question to answer, John. You're really not having an easy time of it this evening. But if you could you maybe war game it a bit?
All right. Yeah, let me put that hat on for a moment. Okay, now, first of all, Ukraine is a huge country, and it's one without natural borders. And that's kind of why it has been a battleground so frequently throughout history. It has terrain, which is maneuverable terrain. That is a mobilized army with mechanized, troop transports, tanks, you name it. Can operate there quite easily. And indeed, the single largest encirclement of any army in history was the one by the Germans around Kiev early on in Operation Barbarossa when they invaded the Soviet Union.
Yeah.
I believe that is the single largest encirclement in history in terms of the total numbers of troops that become cut off. So, I mean, this is the whole nature of what we're talking about here. It's a classic land warfare place. You can't really supply such a huge area by sea. Yes, there's the Crimean Peninsula, which Russia currently controls, but the rest of Ukraine, there's not a whole lot the US Navy could do to support operations there. It's going to be a land battle, and to some extent, of course, air power will be involved in that land battle. However, this is where it gets problematic. Missile technology being what it is makes it far, far more difficult to achieve air superiority today. Russia has very good cutting edge missile technology. It does not look to me as if the US and NATO could meaningfully achieve air superiority without an unacceptable loss of aircraft. So that means they're going to use aircraft in a supporting role and a targeted strike role rather than a saturation role to support sustained ground operations. What that means is that it's going to look, if it happens, God, I hope it doesn't, it will look astonishing like a conventional
War, yeah.
land battle.
From the last century.
Which army will do best in Ukraine in a conventional land battle? Well, guess what? The one with the shortest supply lines. It's just a no-brainer. The shorter your supply lines, the bigger your advantage in a conventional land battle. That's all you need to know. And guess who's going to have the shortest supply lines by far? It's Russia.
Yeah. Yeah.
And so I believe NATO is a bit of a paper tiger in Eastern Ukraine. Western Ukraine might be a different story, but the disputes are not about Western Ukraine. The disputes are about Eastern Ukraine. I don't see how NATO could fight and win against Russia there. I just don't. Their supply lines will be too long. They just won't be able to do it. They'll lose too many aircraft if they try to provide saturation support. I just don't think they can do it. That's my opinion.
Yep. Well, John, thank you for John, the viewer. Thank you for such a question. We're really putting the great John Butler through his paces this evening.
Whatever, Boaz.
As I say, a very very big question and a very good answer, John. Considering we just put you on the spot like that, so thank you for that. Robert asks, hello lads, I have bought a very large sum of gold sovereigns using some of his crypto profits. Will this be useful if the worst happens vis-a-vis armed conflict? This is another very big question. And he has turned down storage because of counterparty risks, think Northern Rock. Now, it's quite understandable. Most guys who are into gold are, very often, a lot of guys who are into gold, I should say, don't like having it stored by other counterparties because, of course, they can go default. It goes against why you would own gold in the first place. That said, Robert, I would say if you're doing own quite a large amount of it, you should invest very heavily in make sure it's very secure. Your operational security in not allowing other people to know that you've got it and hiding it away and making sure that they can't steal it from you. Regarding armed conflict, well, it's not. Maybe it'll save your life, but regarding inflation during armed conflict, it'll certainly help you there as an investor. When it comes to what you should be really, really worried about during armed conflict, it certainly helped a lot of people in the past. I believe during the first Gulf War, a load of RAF pilots were given bags of 10 gold sovereigns, I believe, each. From Her Majesty's government, because sovereigns are very well recognized in the Middle East, and a load of those were returned. I believe they're now in a museum somewhere. But there is a military recognition of that, of the value of gold, the power of gold. People talk about having a silver tongue, but a golden pocket is very valuable as well. John, would you add anything to that? I mean, we're getting pretty dark here with all the war stuff, but
Look. I mean, no matter what you expect for the future, you should own some gold. Okay. However, you do need to think through how you own it. If you simply own a small amount of gold and you kind of like collecting coins and whatnot, fine. You can keep it at home. But if you're going to allocate any meaningful portion of a major investment portfolio, your nest egg, your retirement funds, etc., if you're going to allocate a meaningful portion of that to gold, and I think you should, regardless of the doomsday talk here, right? I think you should own it as an insurance policy regardless. You really, really want to rely on a third party, but you want to rely on a third party that does not have a direct debt and leverage link to the modern banking system. And there are many ways to do that. There are many gold custodians out there, precious metals custodians, if you'd like to generalize, who provide extremely low cost custody, which is totally outside the banking system. There's no debt involved. There's no leverage involved. Indeed, securities law isn't involved because you simply own the gold directly under so-called bailment law. That is, they're simply the custodian of your asset, but the asset is not itself a security. And so there's no force majeure. There's no other potential securities fraud hocus pocus that can take place there. And there are very, very reputable firms that can provide that sort of service for very low cost. So that is my recommendation for people who want that insurance policy that precious metals can provide. So again, as Boaz says, I'm not going to offer investment advice in that sense, but it's kind of funny. I mean, the meaning of investment advice actually falls under securities law. So when you're talking about precious metals, as long as you're not recommending a listed product, it actually doesn't count as financial advice.
Right. Yeah, indeed, John. I would second what John says. It is, while you should definitely have a bit of gold, I would say, for the future as insurance. If you do have an awful lot of it, it does become a little bit of a liability in case anybody does break in, because you can't really get a lot of it back if they're very good at what they do, which burglars, of course, often are, sadly. Now, Riyadh comments, on the one hand, if the Fed raises rates, it would depress economic activity. On the other, if they keep it constant or decrease further, it will cause more inflation. What's the third option? Well, the third option, Riyadh, is what everyone at the Fed aims for, which is the Goldilocks option, which is right in the middle, just warm enough. And that's where there is a little bit of inflation, but not so much inflation gets in the way of growth. So you get the most growth out of it. Now, this is, of course, this is portrayed, this is publicized as being a very easy thing to do. We've got all these PhD economists over here. They know exactly what they're doing, and they're always going to get it. But in reality,
talk about threading a needle. Okay, I mean, look, you heard it here first. Goldilocks is dead. There's no way to navigate this one. I'm sorry. There's not. The Fed is in a bind. They are simply not able to create a good outcome out of this situation. They're not. Someone's going to have to pay. And if you choose to inflate your way out, right, one group pays. And if you choose to deflate your way out, another group pays. But someone's got to pay. And we've borrowed all this consumption forward in time. And it has to be paid for. There has to be an accounting. There has to be a reckoning. And there's no easy way out. And in fact, really, it boils down at that point to a political decision. How do you balance the conflicting interests such that you at least manage to keep the political situation stable while you work your way through this process? So yes, Goldilocks is dead. Now, there is, however, potentially a way to resurrect her, but that has to take place on the supply side of the economy. You have to do fundamental supply side reforms to revitalize the underlying economy and to bump up its potential growth rate. So what do? Deregulate, lower taxes, or better yet, simplify the tax code so that compliance costs are a hell of a lot lower. And all of those extremely intelligent accountants, tax accountants and lawyers have to go find more productive jobs rather than just help administer and navigate the tax code. There's all kinds of dead weight loss in modern economies, all kinds of dead weight loss. People pushing papers around to comply with tax and accounting rules, various regulations, and so on and so forth. If you want to try to get out of this problem, that's what you do. Address the supply side. And there's hope there to resurrect Goldilocks, resuscitator, whatever it is. It looks like we might have lost Boaz, folks. I believe he will be dialing back in. I do think one thing he wanted to transition to at right around this time this evening He wanted to transition to our long and short discussion. That is, we always tried to come to these with one idea for going long the market, one idea for going short the market. And I'd like to add mine, which, believe it or not, actually does kind of follow on this discussion that we had earlier. It's the logistics side of the equation. All the logistics problems that were created by a combination of all the lockdowns that we saw, together with the boom in demand that we saw coming out of lockdown, that to me remains an opportunity. And this is why any multinational worth its salt, any major global corporation has seen now just how disruptive just in time inventory and supply chain management can be in this world we live in, where there are these risks that can arise out of the blue. And I believe logistics firms are going to find that corporations in general are looking for much more comprehensive crisis risk management planning, prevention solutions. And they are going to be willing to pay for those. Corporations don't like their value add chains being fundamentally undermined and disrupted by things they have no control over. But the logistics industry has the ability to be flexible, to adapt, to provision, to prepare, and to build extra capacity. And so I believe the global shipping industry, I believe, and that's true of seaborne, airborne, rail freight, trucking, you name it. This, I believe, is going to be one of the best trades here, because what we've seen may be a one-off shock to logistics, but everyone's now going to want insurance against a similar future supply shock. And the only way to do that is to have more logistical capacity to provide the backup, the insurance, in the event we ever end up into a situation like this again, where there's just not enough port capacity, not enough cranes, not enough rail cars, not enough containers in the right place at the right time. And so I think that logistics is going to see a sustained boom as a result of what's happened, even if the situation begins to normalize over the coming months. So that's my long. Boaz, you're back with us.
I am indeed. I'm sorry about that, folks. A temporary loss of internet. Hope that didn't cause too many troubles there. We are back online, rocking and rolling. John, I believe you were leading on to our nice long, short section. I did get the last of that there. It did sound like
that was the long. The long is logistics, the logistics sector. I think the shock that all of this has done to businesses around the world, they're all going to want, their plan Bs, their insurance for the future against any similar disruptions. And that's going to bump up demand for general logistical capacity, more flexibility, more capacity, more options in the event a given supplier goes wrong, can't ship from a given location. That to me is going to be a sustained boom for the logistics industry, all aspects of it, if you ask me. That was the long. The short, I'm going to borrow a previous short. And basically, it goes back to what I said earlier on this call also. Tech is still just so obscenely overvalued. Leave all of the stuff we discussed aside. Geopolitics, the Fed, Omicron, you name it. Tech is still just so overvalued. I don't care what brings it back in line with the broader market. Something's going to do it, if only under its own weight. So I would stay short tech here, but I would add this logistics long. I think it's a great place to be invested now.
It does feel like logistics could become a very well. They already have over the last couple of years. We've seen all manner of supply chain issues arrive with when you're looking at what happened in the Panama Canal, or if you're looking also at what happened in various commodities. There are all manner of supply chain issues there. I do wonder whether or not. Well, actually, John, I think you'll probably be able to answer this. The firms involved in logistics, there aren't too many of them out there, and I would imagine they have an awful lot of pricing power when it comes to what they can demand from the source of commodities, for example, that they're shipping to.
Absolutely, no, absolutely. This is where this is pricing power is key in an inflationary environment, and logistics firms. It depends, right? They end up sometimes with overcapacity. And if there's overcapacity, then fine. They're not going to have much pricing power. But we've entered this new world where everybody wants more capacity as an insurance policy against future disruptions. And so I think logistics firms are really going to have a free run of it over the next couple of years as everyone makes that adjustment.
Yeah, I think they'll be able to demand a blank check from a lot of
Yeah,
these companies that just aren't used to having to pay for that.
I
Now
think so.
that's your long, John.
Yeah.
Well, and the short being tech, of course. This week, we are onto the sort of slightly more light-hearted part of the show, of course. At this point, uh, I would say, in terms of my long, over the past week, I got back a couple of days ago. I have been in Northern Ireland, and my long for this week are banknotes in portrait mode. And by that, I'm referring to banknotes that have been printed vertically. Now, here, if we're in England or in Scotland, or Wales for that matter, you do get banknotes. They're always printed left to right. It's always horizontal. That's what we're used to. And up in Scotland, there are banks there that can print their own designs, but still they are always still that left to right model. But I have been in Belfast for the last week, enjoying some of the pubs there, and I did get to try some of the banknotes too. And I was interested to see that I don't see how closely you can see it, but their banknotes are printed vertically, like Swiss francs are, and they're very bonny indeed. So this is from Ulster Bank. This is the £20 note, and it does just make a lot more sense when you've got them in your hand to have them printed vertically. If you're a proper weirdo, you may have heard of like me, you may have heard of the Banknote Society, which every year awards Banknote of the Year. It's often the Swiss that win it because they've got similarly portrait mode banknotes. But I do think that those portrait mode banknotes are very good indeed. So I'm long portrait mode banknotes. I think more people will come around to it. I think it's pretty good. My short for this week, meanwhile, is countries where the words "papers, please" are going to be repeated a lot over the next few months. I don't think this has ever been a very good idea. But sadly, the phrase is coming back in vogue in certain areas, like we're discussing with Germany and Austria and various other countries too. So, while I'm bullish on that phrase, because sadly a lot of people think it's a good idea, I'm very bearish on economies where "papers, please" is being repeated a lot. Now we have been on for we have almost done our hour here, John. Though we do have still plenty more comments here. Just in terms of our closing remarks, sorry folks, when my internet died, I did lose most of the comment history there through the platform we're viewing this in. So I have lost some of the questions that we could see there, but I'm seeing a lot of positivity in the comments. It has been great. It has been a very good show. We have covered all manner of bases. Thank you all for tuning into it. And indeed, just in terms of the number of different topics, I think this might be the most varied episode of Southbank Live we've done yet, John. What do you think?
Well, I guess it might be. We did move around quite a bit, but let's face it. I mean, there's a lot going on. There really is a lot going on, and look, it's a fascinating time to be an investor. Yes, okay, fine. That also means it's kind of frightening, but it is a fascinating time to be an investor, and I feel like I'm learning a lot actually because there's just so much happening that I have never experienced in my own investing life. So let's hope I learn the right lessons. Let's hope everyone does.
Indeed, let us all learn the right lessons from this very strange time that we're living in at the moment. I do hope that these shows are being somewhat informative, even if we're just shedding light on some of the problems that we might encounter that hopefully we don't encounter. But yes, thank you to all who tuned in, and indeed, John, thank you for such great answers today. I think this is probably, in terms of the intensity of the questions, and then with my internet dying at the end there, I think this is probably one of the most intense episodes that we've done for you. So thank you so much for joining me.
Yeah, my pleasure.
Thank you, folks. That's all for Southbank Live episode 22. We shall be back next episode with Southbank Live episode 23. That shall be next week. I'll be in London by that point, but we shall be hosting the show as usual, all being well, that is. I hope nothing crazy happens in the meantime. But thanks all for coming in and commenting. Really great to see so much engagement from our audience there, and it's great to see that so many of you enjoyed it. So that's all from us for this week, but all being well, we'll be back with you next week. Hope you're all safe and sound, not getting any of this Omicron variant, and we'll see you then.